Okay, hello everyone. Welcome to the Art of TradeStation. I'm David Russell, VP of Market Intelligence at TradeStation, and today we're going to do a webinar talking about going deeper with market breadth. All right, before we get started, I'm going to share some links with you guys. We're going to share those in the chat. Any questions you want to do, please ask in the chat as well. There's a zip file and some disclosures that we're going to put in there in a second. All right, so this content is for educational and informational purposes only. All symbols, financials, instruments, or trading strategies discussed are for demonstrational purposes only and are not research or recommendations. TradeStation companies do not provide legal, tax, or investment advice. Past performance, whether actual indicated by historical tests of strategies, is no guarantee of future performance and success. There's a possibility you may sustain a loss equal or greater to your entire investment, regardless of which asset class you trade: equities, options, futures, or cryptocurrencies. Therefore, you should not invest or risk money you cannot afford to lose. Online trading is not suitable for all investors. Visit tradestation.com/important information for a copy of the document, characteristics, and risk of standardized options. Before trading any asset class, customers must read the relevant risk disclosure document, characteristics, and risk are important documents and information pages. System access and trade placement and execution may be delayed or fail due to market volatility and volume quote delay, system and software errors, internet traffic outages, and other factors. TradeStation Technologies Inc., TradeStation Crypto Inc., and TradeStation Technologies Inc. are each wholly owned subsidiaries of TradeStation Group Inc., all operating and providing products and services under the TradeStation brand and trademark. You Can Trade Inc. is also a wholly owned subsidiary of TradeStation Group Inc., operating under its own brand and trademark. TradeStation Crypto Inc. offers self-directed investors and traders cryptocurrency brokerage services. It is neither licensed with SEC nor the CFTC, nor is it a member of NFA. When applying for purchasing accounts, subscriptions, products, services, it's important that you know which company you'll be dealing with. Please visit tradestation.com/important information for further important information explaining what this means. All right, so any examples this provided are hypothetical in nature, do not reflect results actually achieved, do not account for fees, expenses, or other important considerations. These types of examples are provided to illustrate mathematical principles and not meant to predict or project the performance of any specific investment or investment strategy. Accordingly, this information should not be relied upon when making an investment decision. We're going to be using some exchange traded funds, so I'm including this as well. ETFs are subject to management fees and other expenses. Before making investment decisions, investors should carefully read information found in the prospectus or summary prospectus, if available, including investment objective, risk, charges, and expenses. The prospectus is available here, tradestation.com/insight/ETF disclosures. We are providing that into the chat. Hopefully you guys will get these links and we'll repost them again. See the standardized returns tab in the included workspace, which is in the zip file. Performance data shown reflects past performance, is no guarantee of future performance. The information provided is not meant to predict or project the performance of a specific investment or investment strategy, and current performance may be lower or higher than the performance data shown. Accordingly, this information should not be relied upon when making an investment decision. All right, so we're going to be using ETFs simply for analytical purposes, but wanted to just kind of let you know that we are doing that. Now, if you open up the zip file, which was one of the links we gave you, this is what you're going to see. You're going to see Art of TradeStation, November 2020, breadth final slides, which is the PowerPoint I'm working through. You're also going to see this indicator is an easy language file. And if you double click on it, if you have to have TradeStation open, it will bring up a dialog box like this, and it will import a series of indicators. You're going to want to import those indicators in order to use the workspace that I'm providing, which is the last thing, which is this one called market breadth. So if you want to go ahead and do that, remember you want to use the ELD before you open the TradeStation workspace. That's just important. All right. So before we get started, I did want to kind of take a quick look at the market because we do have some very interesting sort of price action today. I will also very quickly show you some of the stuff I do here at TradeStation. If you're on the TradeStation website and you go to Research Insights, this is the blog I write, Market Insights. And if you go to this one article I wrote yesterday, I was noticing there was layoffs. There's an increasing amount of layoff information. It's pretty interesting to see that layoff as a trending term is going up on Google. Then at the same time, we see today's CPI number was not very scary anymore. And what I thought was very interesting about it was that used car prices, which were one of the first things to go haywire back in 2020, fell again. If you look at some other numbers that have come out recently, was you would see the Institute for Supply Management has these purchasing indexes. And we actually saw last month's price index fell for the first time since the middle of 2020. So what's interesting is we saw ISM lead inflation at the very beginning of the pandemic in like the middle of 2020. Over a year before anyone talked about inflation, it popped up in the Institute for Supply Management price index. That index turned negative last month. That number came out last week. So you have used cars, an early indicator falling. You have ISM prices falling. And then we have various measures of house prices falling. Very interesting. So we have the Fed's dual mandate, manage inflation, some signs that that's coming under control. The second thing is full employment. And then you look at like today's initial claims were higher than expected. We see the layoffs happening. Those things also point toward the Fed's other part of its dual mandate of jobs. Both of these things make more of a potential of pointing toward a reduction of the Fed's sort of hawkishness. And I want to just look at some other things that happened. This is very quickly. I just created this workspace really quick. So we have here, if you look at the S&P, this chart pattern is called a kicker. This is when the candlestick knifes down and then it just gets completely rejected. This is a bullish reversal pattern that marks the end of a downtrend. When you see a pattern like this, it's like if you didn't buy here, it's like it's just kind of too bad. That's the way it often works. And usually something like a kicker, it can be a pretty interesting sort of pattern. So I want to show you that this is, to me, some interesting sort of price action on the S&P, the main index. Another thing that is interesting. All right, so let me just also show you, aside from market insights, I do these ideas on TradingView. I'm going to go ahead and share the TradingView links in here very quickly. We have two articles I want to mention. One is, if you look at what's been happening with bond yields, there is some real signs here that bond yields have peaked. Also, the euro having bottomed potentially, and what that means, because so much of the weakness in the equity market has been because of the strong dollar. The euro gaining means the strong dollar is going the other way. So we see now signs of bond yields moving in more of a downward direction, of having potentially peaked. There's a lot more to look at. If you look at the idea on TradingView I wanted to just kind of share that because, between the kicker we had on the S&P and a lot of other things happening, there are some things about today that we might look back on in several months. The other thing I want to mention is if you look back to 2000, not in 2000, 1994, the Fed was raising interest rates. And what happened was the market started rallying about 17 weeks before the Fed stopped hiking. So if you just kind of look out to the potential of the Fed going where it's going to go to around, 4.5% to 5% in the first part of next year, we're starting to get within that time horizon of a point in time where people can actually look out and see the potential for a situation that is less hawkish. So I want to just put that out there. We've seen very often stories build for a long time before they really start happening. And then and we've seen the different pieces of the inflation story coming together. We're seeing this in the bond yields now. We're seeing it in the currencies. There's a lot of different pieces here that are all kind of pointing in a potential direction that might be interesting. So I think it's wanted to kind of mention that. All right, so getting back to breadth, it's funny because in some ways breadth has been, the market has been so dominated by mega cap technology stocks that breadth has not been, in the last couple of years, always the most useful tool. It is a great tool. So a lot of what we're showing here now is stuff that is just, I want to really show how TradeStation can explain and show a lot of these patterns in the market. I want to show you some of these tools because over the long run, breadth is an important part of the different kinds of ways you can look at the market. So I showed you how to load the workspace. Now we go to market breadth. Market breadth analyzes the strength of the overall market by showing how stocks are performing in aggregate. Market breadth looks deeper than the simple price performance of market cap weighted major indexes like the S&P 500 and NASDAQ 100. Breadth can help anticipate reversals or confirm direction. So the limits of market cap weighting. S&P 500 and NASDAQ 100 emphasize stocks like Apple based on market cap. Well, this shows total money in the market. It can overlook strength or weakness in stocks overall. So as of late October, Apple was bigger than more than half of the NASDAQ 100. It was bigger than the combined 60 smallest members of the NASDAQ 100 and the 200 smallest members of the S&P 500. So, in some ways you can obviously see when Apple does something, it impacts the broader market in various ways that is outsized. And this is what Breath tries to look past. Mainstream indexes can make it hard to see hundreds of companies and entire industries that may be lagging or outperforming. Standard benchmarks also don't show which sectors are leading, which can provide meaningful clues of investor sentiment. That was slide number 9 if you want to follow. So the first tool we want to start with is the advanced decline line. This is slide 10. Advanced decline line compares the total number of advancing stocks to the total number of declining stocks as a running net total. The actual number itself doesn't matter. It depends when you start it. What we look for is we're going to look for highs and lows to confirm or cast doubt on trends in the bigger index. So a rising advanced decline line is potentially bearish. A falling one is bearish, and a rising one is potentially bullish. Okay, so you need to have a few different things for this to work. Now, I've built this and shared it in the workspace with you guys. I want you to understand. All right, so let's go to the market breadth workspace. This has a whole series of charts. And you're going to see market breadth is one of these things that you kind of have to really have a dedicated chart for. It might be a good idea to do that. You don't really want to monkey around with it very much once you have it in place, and I'm going to show you why. So what we really have here is you have a main chart with the key index, and then you have multi-data charts with other symbols for the advancing and declining issues, and then you're going to have a subchart with the advanced decline line indicator. So what we have here, when we look at something, I'm going to start with this one, to start. So this is just the S&P 500, but now I'm using SPY, and one of the reasons is because sometimes when you use different indexes, they might have different time frames or delays, and that can cause problems. Sometimes it doesn't want to work with one or another, and maybe one customer has one delay and another customer has a different delay. So by using SPY, it works with all these different things. But let me show you something very simply here. If we go on any chart to data, and then you go to edit symbol, you can see this actually has 3 different symbols. It has the SPY, it has advanced $DECL. Those are the advancing and declining issues. But what's interesting now is if I look at one of these actual symbols, if you go to scaling, you can see that I hid them, so you cannot see them. These numbers are just kind of a bunch of gobbledygook that go up and down. They need to be present on the chart. And then what you do is you add a study, which I've already done. You go to studies, you can go to add study, advanced decline line. And when you go to this, for inputted data, but it's going to ask for data 2 and data 3 or whatever it's going to ask for. This is where you put in, this is why you have to have the data plotted already. So right here, when I go down to my advanced decline line, I double click on it, you're going to see that it calls for 6 and 7. For some reason, this chart has the inputs as data 6 and data 7. So those need to be present as symbols on the chart, and then the indicator will draw on them, and then it will do all the computation and running totals, and it will then show you, it will actually plot the advanced decline line. So I want you to understand how this works. It's a main symbol with then 2 other symbols, advancing issues and declining issues. Then you just hide those, and then you use a study that references them, and then you're going to use the output of that study. So it's a little, just to understand all the steps we're actually going through here. All right. So I suggest keeping dedicated charts for each index, because for the NASDAQ, we have a series of advanced and decliners. We do also for the Dow. I'm not doing the Dow in this one, but you could do it as well. And they're doing the S&P, the Russell, and the and the NASDAQ 100. So I have dedicated charts for each of those. These are the actual symbols that we're using for the for these different charts. So like I said, what you do is you go to add to charts, you add an extra data, and then you go to studies, add study advanced decline line, and then you use the data as the inputs. That's how it works. All right. So I wanted to kind of show you some different examples that we might have here when we look historically at the advanced decline line and how it can actually give you kinds of non-confirmation. Signals can occur when the index makes a new high as the advanced decline line falls, which represents potential non-confirmation. So if we look now at some of these examples, we go to late 2001. Now I'm going to use here this initial chart. Now, I wanted to show you one little thing I'm doing. This is actually using the advanced decliners on the New York Stock Exchange. It's not exactly the same thing as the S&P 500, but it's pretty close. And the reason I'm doing that is simply because it has more historical data. But let's look at late 2001. I've actually drawn a line here. Well, actually not for this, but in wait, let's kind of adjust this. As you go back over history, you want to kind of use this. I'm late 2021, I should say, sorry. What you actually start to see here is you see at this point in time, you start to see the advanced decline line. Wait a second. Actually, I'm going to go back to a different point in time. I think this one was one I had in my notes wrong. Over here, this line we want to look at, this one right here, which was in 2018. So if you look here at what the market was doing, the market at this point in time, in September of 2018, the market was proceeding to new highs. The advanced decline line, though, really starts to give a non-confirmation of those highs. And at this point, you can kind of see we've hit a new high and we kind of sat there. We failed to hold it. And at this point in time, this was a pretty strong sort of bearish signal. That was in August and October, through October of 2018. If we go back to June and August of 2015, right here, we can also see, when you're going over periods like this, the advanced decline line, you kind of want to drag it around a little. So if you look right here as well, we start to really see that the advanced decline line really started giving a whole bunch of negative sort of movements all throughout this period of 2015. Now, this is a kind of classic signal that you'll look for in the advanced decline line. This was in the market at a big rally coming out of 2012, like 13, 14, and 15, early 15 were these big rallies. And then it just kind of had this big topping pattern. And over this time, you can see that the internals were deteriorating, the advanced decline was weakening. There's a classic example of the advanced decline line giving a signal before a big drop. That was in the summer of 2015. Go back further to October of 2007. We also see a similar sort of thing when the advanced decline line, if I bring this up and then zoom it in, you can also see at this point in time that you had a lower high here. The market made a higher high before the financial crisis, and the advanced decline was making a lower high. This is one of the most classic signals of advanced decline line. This is a classic non-confirmation, and this is what it means by a higher high with a lower high giving the non-confirmation. And if you also look back to the late 90s, in fact, there was one here at this point in 2006 where you also had the advanced decline line was trending down. And if you look back at the late 90s, you can see that going into the .com, there was actually the advanced decline line. It's hard to see on this, but the advanced decline line was actually petering out like basically for an entire year going into this. So anyway, that is your kind of historical examples. Those are the sort of things we want to be looking at. And the thing is that at this exact moment in time, it hasn't been giving a huge amount of actual signals. Now, actually, I see now what I was trying to refer to earlier. Sorry, the scaling got messed up. Look right here. November of 2021 through this point in time right here in January of this year, you actually see higher high, but then a lower advanced decline line. So this was also a classic example. And when does it come? It comes at the end of a long bullish uptrend, and it peters out when you have less and less leadership. And we're going to see that with some of the other indicators I'm going to show you that also fall under breadth. All right, would this work on a smaller time frame like 5-minute charts? I don't think so. This is really for, I think there's so many other things when you get onto an intraday chart that can impact time of day. There's a lot of different patterns on intraday charts. And I've never tried to use breadth over any kind of period of time. What I would use would be something like RSI. RSI I have found to be far more reliable on shorter term time frames, and it can give similar signals. So are we recording this webinar? Yes, and it will be on YouTube. Okay, that was slide 13. Let's go to slide 14. Moving, all right, so next thing we're going to show you. All right, so I just used, if you're looking at the way I gave you the workspace, it's the one that's second from the right is the one I just did. And just to make it simple, I'm going to hide that for now. Okay. Now remember, if you want to see standardized returns of any ETFs, right here we've created a special part on radar screens to actually see it. This will always update with values as of the end of the preceding calendar month. Just want to let you know that we are providing that. And we're going to look at some of these ETFs as well in a minute. But first, let's look at the moving average indexes. So what's interesting is how many companies in the S&P are above their 20-day moving average or above their 50-day moving average? Those are sort of questions are actually kind of interesting. And those are another way to measure breadth. How many companies are, would be considered in a sort of bullish intermediate or short-term trend. And you can do that simply by looking at the number of companies above or below the moving averages. So there are also pre-calculated indexes that can display the number of stocks above and below key moving averages. Drops can show weakening breadth, and it's interesting to compare the number of how I like to do it, and there's other ways, but you can look at the number of companies above the 20-day versus above the 50-day, and that can give some interesting signals when the two cross over. So what we have now is here, I'm going to go to the S&P 500 on SPY. Like I said, we have SPY, we have the NASDAQ, which is the Qs, and we have IWM for the Russell 2000. These are the three big indexes that I wanted to look at today. And I'm using the ETFs because the ETFs will jibe better with these other indexes. So this chart has a lot on it. So let me explain this to you. We have the main chart up here. I use blue for the 20-day and red for the 50-day. Simple moving averages. Down here, these lines show the number of companies in the index, in the S&P in this case, that are above the 20-day or above the 50-day. So what's kind of interesting is you can see these things providing kind of crossover signals. And very often, if you look at different points in time, like even right here, for example, the 20-day moved above the 50-day, and it was then followed by a rebound in the market. It's interesting. And then very often you see the same thing where this is an example of a weakening sort of breadth right there. The number of companies above the 20-day fell under the number of companies above the 50-day. And then you can see that this bounce just kind of just died. And this is very often when I found this indicator to be kind of useful. This is very often something that can confirm a direction you want. If you're bearish and you're looking for the market to go down and it rallies and you're shorting it and you're like, wow, it's not working for me yet. This can give you the kind of confirmation. And this is where I always have thought breadth should be used. It should not necessarily be used kind of like, as the dominant analysis that you use, because the dominant thing is always going to be price. That is ultimately how you make money or lose money, by being right about the price going in a certain direction. But things like breadth can help confirm trends and moves. So that's really the sort of thing that I wanted to highlight about this, is that this is an example of, if you were bearish and you started shorting here and you're wondering why you're losing money, this is often the kind of place where the breadth can give you a potential signal. And this is where a signal like this. Another example was in August of this year. I just wrote this down. So if you look at the same sort of thing, big rally, and then look what happens here. That 20-day falls under, and that was also a signal. And what's interesting here is that the 20-day crossed above the 50-day before the market bottom. We had that false breakdown back there after that last CPI. Excuse me. So I think you see that this can actually provide some different sort of signals. So I wanted to just show that very quickly. So what this is let's look at this chart also. For any TradeStation chart, for these charts in particular, you can go to data and then edit symbol. It shows you all the symbols on the chart. So we have the main SPY, but then we also have these other indexes. And you can copy and paste these out of here if you want. You can like go to this. We could even like this is a number of companies in the S&P over the 20-day moving average. You can just go right in and copy this. I could just copy this symbol. I could jump over to like this other workspace I have, for example, and I could just paste it in and you could actually see this is what it looks like. And in and of itself, it doesn't tell you a whole lot, but when it's put in context, it can be useful. So you go do that by going data, edit symbol, and you can see all the symbols on the chart. Now, if you click on them, you can see that this one is go to scaling and you can see it set to subgraph 2, which is right there. So that is the 50-day, the companies above the 20-day and above the 50-day. The next one is companies making new highs and new lows. I'm going to explain that in a minute, but let me just show it to you here. That is this middle chart, the red and the green lines up and down. So let's actually go here and double click on this, and you can see this one, go to scaling, subgraph 3. So it all makes sense. This is graph 1, subgraph 2, subgraph 3. It's that simple. So what I did was I just organized them. I can tell you, it took me like a long time to figure out how I wanted to present this. And I feel that this is a very good kind of organization. So I want to just mention it. If you load this workspace, I would suggest that you don't change the symbols. Don't mess with it. This is for SPY. This is for, the NASDAQ, and this is for the IWM. Because if you change SPY, if you change this to Qs or Apple or something, it's still going to show you the S&P companies above and below the 20-day and the 50-day and the new highs and new lows and the advanced decline for the SPY. These things will not update with the primary symbol, which is data 1. Just realize that. So these charts I would keep as a workspace separately. It's your breadth workspace, and leave it alone. Open it up, look at it, close it. Don't save it, because if you make any changes, then you might mess up a scaling or something. I've done this. So I wanted to just kind of tell you how these can be used, and they'll always be useful for you that way. So remember, this chart has many different symbols on it. Now this is down here is the advanced decline line. You'll also notice if we go to our data, we go to edit symbol, and you can see here's our advanced decliners for the S&P 500. If we look at these, you'll actually see, we go to scaling, that these are hidden. So what we're showing here is a study. Like I said before, it's a customized, you can use an indicator, and you can see it's using data 6 and data 7. So I wanted to just show you how this actually works. Sometimes the advanced decline stuff is confusing to some people, so that is how we use it. Why don't you see all data indexes on SPY chart when you have added all? In other words, how can you hide a few data indexes versus showing the remaining? All right, you understand. You can put, I think, 100 data into a chart and then hide them and then use them for indicators and all kinds of crazy stuff. And we can get into that a whole other time. You can do spread ratios and stuff like that. But just realize that there's data and there's indicators, and that's what we're working with. Okay, so let's go on now to companies making 52-week highs and 52-week lows. The number of companies making new 52-week highs and new 52-week lows can also help measure market breadth. The included workspaces show new highs and lows for the S&P 500, NASDAQ 100, and Russell 2000. So here we have the S&P 500. This lower chart shows a number of companies. The green, I just did it very simple, color-coded. Green is companies making new highs. Red is companies making new lows. So let's take a look at February of 2018 here. There was an interesting example I saw. Sorry. All right, look back at February 2. This was a crazy mark. I remember this rally. Does anyone remember this? This is when everyone was shorting VIX. There were these crazy instruments where people were selling volatility, and the market just went up like straight up it was crazy. It was a complacent just melt up. Now, this is another classic example of when market breadth can be useful. I already mentioned how the actual advanced decline line was weakening there, but market breadth is most useful, in my opinion, at the end of a long bullish run to know, all right, this thing is actually losing its gusto. And so look here, I already showed you advanced decline, but look as the market makes these new highs in February of 2018. Look at how the number of companies making new highs goes down. That is a sign of weakening breadth. If you look in December, all right, let's look at the NASDAQ now. Go to the NASDAQ right here, and I have also December of 2019. Same thing, as this market was getting tired. Right here, December of 2019, as NASDAQ banging around up there. But look at how when it makes new highs, the exact same thing. Fewer new highs as the market hits new highs. This was an interesting candle as well. It was a bearish outside candle at an all-time high. And then it just came back and tested it. And then it was like, I did some stuff on TradingView at the time when I broke all of this down. So you might want to watch some of the stuff we do on TradingView as well. It's a different, charting service that you can link to your account, but it has some interesting tools as well. Of course, nothing's as good as the platform, as a TradeStation platform, but TradingView allows you to look at some interesting patterns as well. And I publish some ideas sometimes on there. All right. And then look at the S&P in May. This is another very interesting one. If we look back, this is a really interesting one. I wrote about it at the time on Market Insights. Look in May of 2021, the number of companies hitting new highs. I think this was an all-time record, actually. Now, the reason is because it went back to that COVID collapse in March of the preceding year, and then all those companies came back. So in many ways, the rebound from post-COVID was the kind of like every company made a new low and a new high at the same time, so it distorted the data. Nonetheless, after we hit that high, the market continued trending higher for almost another year. I mean, for another 7-8 months. So it's just kind of interesting to see that when things make new highs, it's something to respect. Another point I want to just mention that is interesting is the number of new highs that we saw in late October was the highest reading since basically the market started, back here in March or so of this year. So this was also an interesting sort of signal that we saw. If you look back here, we had something like over 30 members of the S&P were making new highs at the end of October, and the market has not had a significant pullback since. So I wanted to just kind of highlight that seeing companies making new highs and new lows, it can really give some signals. It's also interesting. I'm just curious. I hadn't actually thought about this, but it's interesting if you look at the S&P. We made a new 52-week low there. I just realized this now, but the number of new companies making 52-week lows in mid-October was lower than the number of companies doing it in June. This is also bullish divergence. This is non-confirmation of the low. The last thing I wanted to add to the mix was equal weighted indexes. Equal weighted indexes can help measure market breadth because they don't give more significance to big companies over smaller companies. Like I said, Apple is bigger than 200 companies in the S&P 500. If you go to SPY, it accounts for like 7 or 8% or something of SPY. But if you go to an equal weighted index, it accounts for roughly 1/500th of the S&P 500. That's an equal weighted index. These can be charted against the main indexes using the relative strength indicator. So that is a different indicator, and I'm going to show it to you. It's on this chart with relative strength. So if we look at this, I put this little explainer down here. Negative readings means that there's stronger breadth. It means large caps are underperforming the overall group. So this is actually something where it was just too hard to show it otherwise, so I didn't do it. But what's very interesting here is the actual strength of the equal weighted index here was significantly greater as the market started rebounding. And this shows that in this measure, unlike the advanced decline line, which it gave us some bullish signals here, but what's really interesting is the equal weighted index here gave us a very good indicator. Now, the reason I did this is, you say, why is it red and that's bullish? The reason is because I didn't want to create another custom index. I wanted to use the indexes available to everyone on the platform. Relative strength is an indicator that exists. And what you do is, let's double click on the chart and you can see what it does is it includes this ETF called RSP, which is basically this product I just mentioned, the Invesco Equal Weight RSP. And again, these are analytical tools. These are not anywhere recommendations or anything that that we think that this means RSP is better than SPY or anything of the sort. This is purely an analytical tool, because when the big caps are not, when there's strong breadth, RSP will outperform. So in this case, we're showing that SPY is underperforming RSP, which shows there's positive breadth. Actually, in this case, what I'm actually doing is I'm also showing as well, the white line is actually RSP. So it's interesting here is you can see the big jump in RSP. Now this one is plotted on the left. You can see this is white and this is green. The green matches the candlestick. If I actually show you this, you can see it's on the left axis. So just so you understand, I put a lot of things on these charts. But this is another example that it is basically showing you here that the market breadth is improving. When the equal weighted index outperforms, it's a sign of improving market breadth. Now, it's also interesting. I wanted to just understand the technicals of the platform. The relative strength indicator is different than the advanced decline line. The advanced decline line will draw from another symbol on another data on the chart. The relative strength indicator will simply show the price performance of symbol of data 1 against a symbol that you input into this reference symbol. And then it will show over a time frame. So in this case, it's 10 days. So anyway, what's interesting here is that I want to just highlight that this functions differently than the advanced decline line. The advanced decline line draws on data on the chart. The relative strength indicator uses an input. So I put a second data on here, RSP, as a data, but I just put it there for illustration. It's not actually linked to this. So I just want to explain that to you guys, because some of the different indicators work differently, and it's always just good to see how those work. So let's look now at what we have in Radar Screen. Radar Screen is, if you guys don't know already, is pretty much the coolest thing since sliced bread. It allows you to look at all kinds of different symbols over different time frames and different kinds of analysis. I mean, I use it for a lot of things. In this webinar, what I'm doing is I'm showing different ETFs over different time frames. 5-day is 1 week, 10-day, 21-day. 10-day is essentially 2 weeks, 21-day is 1 month, 63-day is 3 months, 6 months, 1 year. So we have different indicators here. Right off the bat, though, let me just show you. Let's click on who's doing best in the last month. You can just click in the last 21 days, RSP is up 13% and SPY is up 11%. That is a sign of breadth. If you look in the last year, you can see the same sort of thing. Now, what's interesting is that what has happened a lot is the mega cap technology stocks have lagged, and then a lot of other random smaller stocks like energy, which are not big in general, have outperformed. And in some ways, that's why breadth has not been as massively useful in this most recent market environment. But this is still a positive sort of sign of breadth. I have this other indicator, which will basically look in the last 63 days or the last 3 months. Where are these indicators, or where are these ETFs in their range over that trailing period? And 100% means that it closed at the very high. So if we look at XLV, it's at 96%. If we look at XLV, which is healthcare, let's just look at XLV here. You can see XLV closed near the top of its 3-month range. That's how this works. So you can see from all these how different things are performing. And I'm going to get to the sectors in a minute. The other thing that we have here is the NASDAQ equal weighted ETF. Like I said, these are not recommendations. These are not things we want to even think about investing in. We want to, well, for my purposes here, the goal is to use them as indexes. Some of these might not have the greatest liquidity as well. So I want to just mention that. Also, it's interesting to look in the last month, though, that the equal weighted NASDAQ is significantly outperforming. Again, these were signs of breadth that were taking shape before the market bounced today. So it's just interesting. This has really all just emerged in the last couple of weeks, to be honest. When I prepared this webinar in late October, this was not the case. I'm just noticing it now, and it's very interesting to see the NASDAQ having a big update today, but it was preceded by a month of improving breadth that we see on this. So it just shows right here how some of these tools can work. So the last slide I want to go to now is sectors. Sector ETFs. Although breadth analysis doesn't typically consider sectors, they can provide some insights on market internals. Outperformance by safe havens like consumer staples can reflect economic fear. Strength in a lagging sector can show exhaustion of a rally. So what's interesting to me, and I would just note that the current environment we're in is very strange because good economic news has been bad because it's been the Fed is going to be more hawkish. So we've seen industries like energy do better. Industrials have done better because of higher interest rates, even if that's bad for the broader market. So some of these traditional relationships have been less the case in the last, really ever since COVID, it has been all out of whack. But things will most likely go back to the history. Historically, when you start to see something like consumer staples, what you often see is you'll see the safe havens will rally at the end of a bullish run. It's like they just kind of play catch up, and people keep just mindlessly putting money into the market as the individual stocks start to weaken. Now that was actually the case in a big way back in 2015 when the market was peaking at that point in time. Consumer staples started really outperforming right before the market crashed. There are other moments where it is the case. At this exact moment in time, I don't know how much any of these relationships have the relevance they once did, but over time, there's a chance that those relationships and those patterns will reassert themselves. So I wanted to just mention that. If you look in the last month, you can see, for example, that industrials, financials, and materials have done best. And that's kind of interesting. The kind of market we're in now, though, is that from my perspective, that there's more of a risk of these sectors now kind of playing catch up. And this is like your Amazon, your Tesla, your Facebooks and your Googles are down here. So some of these more beaten up growth names, could make a recovery. So in this market, this approach has not necessarily been exactly the most useful thing, but over time, it's an interesting sort of pattern to watch. You'll also see in some of the other webinars I've done of leadership in the market, you'll often see the market split between sort of cyclical growth versus these long, like, secular growth names that benefit from lower interest rates. So you can see different areas performing in the market. What is interesting, though, is that if you're in a growth market like we were in the last couple of years before it started selling off this year, if you're seeing outperformance and stuff like industrials or financials and the big tech stocks are lagging, in many ways that would also be a sign of negative breadth. What you'd actually see is you would see that the real leaders of the market are losing their strength, and people are kind of mindlessly just buying stocks. And then as that money goes into the market, it gets dispersed into the areas that are maybe least overvalued at any moment in time. So then you'll actually start to see that the non-leader groups provide leadership. And that is really one of the most useful things you could do to have a sense of where the leadership is and is it still working or is it dying. A moment like this, the market is potentially at something of a turn, and those patterns will not be evident for a while. Okay, where do I find the files for the workspace? We just shared it. Let me see if any other questions. How do you check the market moving average for the Dow 30? All right. That is not provided in this. I'm not doing the Dow 30. I I didn't have space for it in the workspace. There is actually, there are studies on that, and I don't have them readily available, but I'll tell you what, if you email me at drussell@tradestation.com, I will get that information for you. We do have it available. Would you indicate this as a leading or lagging indicator? I wouldn't say it's leading or lagging. I would describe this as confirmation, non-confirmation. One of the principles Charles Dow came up with technical analysis, and he did it with the transports. He's famous for Dow theory. If the transports don't make new highs, then that means the market's not a confirmed high, stuff like that. And this has become one of the most common techniques for technical analysts. And we want things that confirm a move. And what's interesting is, so I would view it as confirmation, non-confirmation. So for example, what does it mean here? This is a confirmation. The reason is because we made a low and this made a low. But what's interesting is it's not really much, because if anything, if it had made a higher low, that would have been more interesting. And that's why I look at them all together. And I mentioned, for example, we actually saw that this was a bearish indicator, made a lower high. So when you look at the market making this low here, but there isn't anything here yet that would cast any doubt on it. It's making new highs. The S&P is kind of progressing higher. And at this point, breadth is not going to necessarily be the most useful thing at this exact moment in time. So I would say that this is something we want to think about as being confirmation, non-confirmation. And the main thing is we want to look at it as giving us an example of exhaustion. And I would say that if the market, rebounding at this point in time in this bear market, advanced decline line has been somewhat useful, but the thing that I have found more useful has been this 20-day moving average or some of these other indicators that might give more of a pattern. Say you think we're going to go up to a point, stall and break down, you could look for the advanced decline line to confirm that. You could look for one of these other moving averages to confirm or non-confirm it. All right, those are all the questions I seem to have. So it's great talking to everyone. All right, for the NQ, how does this differ than using ADQD? I don't know what that is. Good. All right, folks. Well, it's great to talk to everyone. This will be on YouTube in a week or two, and hope everyone has a great day. And any questions, you can email me at drussell@tradestation.com. And just remember, the way I set these up, these workspaces, you don't really want to change them a whole lot. I'd suggest just kind of leaving them alone, so that they will work for you when you want to fire them up in a month and everything's not all out of whack. Have a great day, and I'll see you guys soon.